What's going on, everybody? This is Phil from Millennial Money Gains, and welcome back to a brand new video. In today's video, we got a very exciting one here for you. We are going to go over O-Shares ETFs, specifically the Quality Dividend ETF, which is ticker symbol OUSA. Now, this is from Kevin O'Leary. For those of you who don't know who Kevin O'Leary is, most people know him from the show Shark Tank. He is a millionaire investor worth just about, I would say, like $400 million or so. And he is the bald guy that likes wine on Shark Tank. But if you guys are hyped for this video, please make sure you smash that like button. Also, if you want to join the family, we talk about dividend stocks on this channel, and you can follow my journey to $100,000 dividend portfolio. All you have to do is hit that subscribe button down below. But now let's hop right into the video. So OUSA, which is Kevin O'Leary's dividend ETF. Let's hop over here. In Seeking Alpha, it's showing that it's currently trading at $43 per share. It is up 14% in the past year. And let's go over the dividend stats on this one. So it pays a 1.27% dividend yield. Now, what's special about this one is that it holds a bunch of high quality dividend stocks that are in the portfolio of this ETF, and that is where you get the dividend yield from. So it's not like other dividend plays such as Q Yield or R Yield where they sell covered calls. This is a strictly dividend ETF that pays out dividends from holding the strong companies. So Kevin O'Leary says that he would never hold a company that doesn't pay a dividend just because it doesn't give anything back to the shareholder. Now, obviously, there is capital appreciation, but you need that consistent payment from the shareholder, from the companies to pay that shareholder. So he created his own set of ETFs. So they don't have any dividend growth. They do pay a monthly dividend, which is 5 cents per share for this ETF specifically. So now let's hop right in. Actually, let's go over the expenses, right, for this ETF. Because of this ETF, they all have expenses. So the expense ratio is 0.48%, so it's pretty high there for an ETF. Obviously, you need to make sure that you're subtracting this percentage, this expense ratio from the dividend, because this is how much this ETF is going to cost you to hold. So you need to make sure that you are taking that from the cost of the company and showing that you are actually going to be paying this in order to hold this and receive this dividend. So now we're going to look at the holdings breakdown. So it has about 22.6% in healthcare, 17.56% in technology, 17% in consumer defensive, 15.64% in industrials, 11.27% in consumer cyclical, and 8.63% in financials, and 7.25% in communication, and about 0.09% in cash and cash equivalents. So looking at the top 10 holdings here, we have, as you can tell, these great dividend holders, these long-term dividend stocks. We have Procter & Gamble at a 5.11%. We have Johnson & Johnson, J&J at 5.09%. We have Microsoft at 4.71%. We have the Home Depot at 4.5%. We have Verizon at 4.37%. We have Apple at 3.86%. Pfizer at 3.74%. McDonald's at 3%. Lockheed Martin at 2.83%. And Comcast at 2.49%. So the top 10 holdings holds almost 40% of the total portfolio for this ETF, and they have 101 holdings altogether. So as you can tell, they do have a lot of strong companies in these holdings. This is the top 25 holdings here. So they have 3M on there, Coca-Cola, Blackstone, PepsiCo, Visa, Philip Morris, and others, just to name a few. So they do have a strong holding of companies here in this ETF. Now, they are just paying out a 1.27% dividend, which is, to me, a little bit on the low side. Now, they're saying that the dividend growth, all these stocks increase their dividends, which will in turn increase the dividend of the ETF. But according to Seeking Alpha here, we have not seen that dividend increase at all. Dividend growth for 0 years, right? So we have not seen that reflective in this ETF. So they also said dividend coverage. Strong dividend coverage may increase the likelihood of dividend growth while potentially reducing the risk of dividend cuts or suspensions. So they do manage this fund, and they do focus on high long-term dividend plays, very strong dividend plays. Profitability, top quartile companies by return on assets have outperformed those in the bottom quartile historically. And less risk. Focus on volatility may potentially reduce severity of portfolio drawdowns during market stress events. Strong balance sheets and quality dividend income. Now, what do I think about this play? For me, I think this isn't a play for me. I personally would rather design my own portfolio. Now, obviously, if you don't want to put in the work and the dedication to read about different companies and do all that, then you can just pick this ETF and that's it and call it a day. But for me, I think I'd rather design my own portfolio. I think they are a little bit too heavily invested in healthcare. I think that they have a lot of different dividend stocks that play in the healthcare field. And I think that's too much for me specifically. I am a more technology heavy investor, and I like more of those tech plays. So for me, this is not a dividend stock for me. Even if I was investing in ETFs, I don't think this would be the ETF for me. Personally, I'd much rather go with VOO, VOO, or VTI, which is what I have in my Roth IRA. Just because something like this, it's too heavily focused on healthcare for me, like I said, and you're getting a lesser dividend than if you were investing in something like a VOO. So for me, this one is not there. But let me know what you guys think about this one specifically from Kevin O'Leary's set of index funds. I want to know what you guys think. If any of you are invested in this, Kevin O'Leary, I respect the guy very much, but I think he could have done a better job with this dividend ETF. Let me know what you guys think about this, if you guys are investing, and some opinions on it. I really do appreciate everyone that watched. If you did get anything from this, please smash that like button. Also, join the family. Hit that subscribe button down below. We post here at least 2 times per week, and we are going to be starting a schedule. We are posting here at least every Sunday and every Tuesday. So make sure you guys are here for that, and sometimes I'll throw in a bonus video for you guys. But I appreciate you all for watching, and I'll see you in the next video. Peace!